All right, we're about to get started here. I want to thank you all for coming to the Micklin Law Group's monthly webinar series. This evening's webinar is Divorces and Taxes, What You Need to Know. I'm going to jump right into it. Let me just get my bearings here. Before I go, I just want to ask, if you take notice to the control panel that you have on the right side of your screen, there should be a place where you can tap down for questions. I'd like somebody just to type in there to make sure and let me know that you can see the screen, the PowerPoint presentation, and you can hear my voice. Okay, I'm going to ask once again. On the right side is a question. You'll see webcam questions. You hit the little arrow so it goes down, and it should open up okay, good. So it sounds like we can hear and see. If that should change during the presentation, try to post into, okay, so somebody's saying they can't see anything. All right, so good thing I asked. How about now? Can you see and hear? Okay, great. It's good. I'm glad I did that because sometimes hard to pick that up during it. If that changes throughout the presentation, just go into that same place and post a comment. I don't always see that portion of it, but I'll do my best to keep my eyes open for it. All right, so let's move ahead. Let me give you a little background, what to expect for today in case this is the first webinar that you've attended. It is scheduled for 60 minutes, 1 hour. I do my best to stay within the time frame, but I feel it's more important to make sure you get through the information, not to get through it as quickly, but I do respect your time. And I know that it's evening, you've probably been working, and I'll do my best to get you through it and through it well. I will stay as long as necessary afterwards to answer questions. So I usually recommend that you write down your questions in the same area that I asked you to prompt if you can see and hear me, so that although I won't be getting to the questions until the end, that way you make sure that you don't miss it and I can make sure I get to it. And like I said, I'll stay as long as necessary to make sure to get to all of your questions. As you should be able to tell, this is a one-way communication, so hopefully you continue to see and hear me, but I can't see or hear you, so you need to communicate through the questions panel. On the bottom right, you'll see there's a handout, which is the PowerPoint presentation. I do that in case you want a copy. Sometimes there are cases and statutes and things that are cited that you may want a copy of. The recording that I'm doing tonight will be posted on my website, www.micklinlawgroup.com, usually in a week or two, but I still always recommend people attend it live. I just think it's better dynamic, and then, of course, you also get the chance to ask me questions directly. Today's date is January 26, 2017. I indicate that so that if you're watching this in the future, just know that laws may have changed. Some of the things and practices I mentioned sometimes change it from time to time. Overall, most things don't significantly change, but it's still good to know the daily so you know where to check and to move on. To those of you that haven't worked or met me, this is me. My name is Brad Micklin. I'm the managing member of the Micklin Law Group. I've been so since 2001 when I opened it. Originally, I opened as a sole practitioner, which means I did a little bit of everything by myself. Over the years, we've grown the practice. We have several attorneys now. We are concentrated in divorce, family law, and estate planning and litigation. I started my career after law school working for Judge Eugene Austin in the special civil part of Bergen County. Then I did some complex commercial litigation with Kessler & Associates. And then, like I said, I moved on and opened my own practice in 2001, where I've been since. My role, aside from managing partner, is I handle more of the complex, either high conflict or high net worth cases and complex litigations on behalf of the firm. These are some of the awards I've received over the years. Fortunately, I have many more that I don't list here, and I haven't updated because I do this not to boast, but just to give you some sense that of my credibility and my concern for my clients and the work that I do. I hope that comes through both in this kind of a slide, but also in the presentations I do like this. The reason I do these webinars in the first place is I've learned over the decades of doing this for people that it's impossible to give anybody enough information in 1 or 2 sittings to help them through the cases that we handle. So I work at creating a library or a form of resources where they can go and obtain information without charge on the convenience of their home. You'll see, in addition to my webinars, my webpage also has a video consultation room where I answer specific questions, various questions on various topics. We have blog posts and other articles also to help you. You can just run searches. So let's take a quick look at what we're going to be talking about today. Top things that I think are most relevant: the filing status. The federal tax brackets is actually 2017. When I did the PowerPoint, I created it in 16, but then I changed it because it carried over into this year. The marital status, how that affects it. Child support and child care expenses are actually going to talk about not only how they are handled in taxes, but also various tax credits that you can receive for children and for educational reasons. The tax consequences and possibly lack thereof for equitable distribution, and everybody's favorite, deduction of attorney's fees, when and how that can be done. So let's move quickly into the filing status. Let's get some basic information first. Most important thing to know is that your divorce or separation can affect your tax filing, that the rate for a married couple is lower than that of a single individual. So that's usually the premise that I start to advise people when they are going into a divorce, to contemplate that it will affect your tax filings and therefore your tax bill or tax refunds. But also, more importantly, another thing you need to consider, that not just the rates, or not just the change in the rates, but the change in the income that you will be utilizing in those rates. So married couple has a lower filing tax rate, but generally will have a larger income because there may be 2 incomes that are being combined. So you may get a lower rate, but a higher tax bill nonetheless. So the point to take from this is these are considerations. You should meet with an accountant to analyze where you will fall, both during and after your divorce, so that you know the best way to file. Of course, filing status, the tax rate is not your only concern. It's obviously the first concern. We'll get into many more as we talk through the evening. So the tax brackets for 2017, this is, again, probably the next place that you want to start. I'm not going to spend a great deal of time talking about them because they're really just numbers. And there's a reason I didn't go to med school. I don't care much for numbers, and you probably don't care much more than I do. These are, unless you're an accountant, of course. So let's just take a quick look at them. The tax numbers on the side of the left side in the red represent the tax limits, or the ranges. So 0 to 9,000 means your taxable income. On the right side are the tax rates. What you want to get from this slide, and the next couple that we'll pass, I'll give you a minute to take them down, is, let me just try to get my little pen going here. When you calculate, you want to be careful that you got to calculate, there's first the flat tax dollar amount, then there's a percentage that gets added, but it's only on the amount, I got to move my thing over here, the amount of income over this dollar limit. So you'll see, I don't know if my control panel shows up in your screen or not, but so don't confuse yourself and do the 932, for instance, and then add 15% of the income that you have in this area. It's only the amount over the 9,323. So for instance, if you have $9,324, you're going to pay roughly $933 in tax, not 15% of the balance. And it's just important to make sure you don't accidentally do that, because it'll be confusing when you get to it. And one thing I may touch on later, that when it comes to alimony, these numbers are very important, because you may earn, for instance, $91,900, and then you get $20,000 of alimony. You're now into this range here, and you're at 28%. So you're going from 25 to 28%. You need to make sure, and again, I'll probably touch on this a little more when we talk about other tax. You need to make sure that the increase in alimony that you're getting is worth the increase in the tax rate that you're paying. So I'm going to pause for a second, let you take a look at these. I know I got some pen all over it for you. These are for single taxpayers. Here we have married filing jointly. And if anybody's, I know you're probably getting taxes ready for 16, you'll notice these rates are different. The income level guidelines change slightly, and therefore the tax dollar amounts, both of the tax amount and how much the percentage over, also changes slightly. I gather it's a cost of living adjustment because the numbers from 16 to 17 aren't significantly different. Okay, I'm going to move on. And head of household, again, you'll notice the same rates compared to, I'm sorry, I didn't change this slide, but it is supposed to be 17. Let me just do it while I got my fancy pen here. So for people watching, note it's 17. My apologies. Like I said, this was done in 2016, preparing for the webinar. I decided just today that I should make it 17 since that's where we are. Here's New Jersey tax rates. My understanding is there is no different based on the your filing status. So these are the numbers and the ranges that they go to. Again, not much to say about it, just to be familiar with it. I'll give you a second to take it down, and then we're going to move on. All right, so moving into marital status and how does that affect your filing. So obviously the important date is going to be December 31st to determine how you file. And the important thing is, even if you're divorced by that day, you have to file single, even if you live together. Now, I have here more than half the year because that's what my research shows, but I believe even if you got divorced on the 28th, you have to file single at the end of the year. I'll go through some more information in a moment about being legally separated and things like that may affect it. And again, when it comes to taxes, I always have to defer to an accountant and tell you to go see an accountant. But my understanding is actually that it's not just more than half the year. It's actually even in the one possible day. If you're still married on that day, now here's where we get into tax law, and you have to get more. You have to read things carefully. And again, if you're not going to have professionals helping you, so you have to see. Get my pen back up here again. All right, so if you and your spouse lived in the same household and were not legally separated. Now that's an interesting issue because technically in New Jersey, there's no such thing as legal separation. Remember, what we're talking about are the federal tax guidelines, not the state. So now New Jersey does not have a legal separation, but if you have a restraining order issued against you, you are physically separated from one another and removed from the household, and I would argue legally separated by the restraining order that keeps you from having contact. But now I've never seen this issue actually determined whether or not it does or does not qualify you, but it's something that you need to look into. But assuming that you are in the household and not legally separated, then you must file as married. Now you can either file joint or separate. Married filing separate or married filing joint. Head of household. If you were, my pen keeps going off. You may be able to file if you were legally married on the 31st if you meet all of these requirements. If you were considered unmarried, you're considered unmarried if you were legally separated. So we have this standard again, which we don't know if it does or doesn't apply. Or your spouse did not live in your home for the last 6 months. And I believe it's an and. Yeah, I'm sorry, because it's all this. And you were unmarried or considered unmarried on the 31st. Now, I don't know what considered unmarried could possibly mean because now my knowledge is based or limited to New Jersey. Jersey, you're either married or you're not married. And it doesn't say legally separated like it does in number 1. So maybe a tax professional has a better answer for you, and I apologize that I don't. But I just know what I know from the code and from the family law. So, and it doesn't end here. Additionally, you have to have paid more than half the cost of keeping up the home for a year and a child or other qualifying person lived with you for more than half of the year, or the other person or the other parent's entitled to claim tax exemption. This here also brings up another problem, and again, it's based more on New Jersey law, because I get into issues a lot because we have child support guidelines, which set, and we'll talk about child support later, that sets how much you pay in child support, and it's based on an income proportionate ratio. So in many cases, if you're the paying parent and you live outside and separate, you will be paying what is considered under child support guidelines more than 50% of the child support, which is what the guidelines supposed to represent, the cost of supporting a child. So technically you're living out, but you're paying more than half of the cost of keeping the home under the child support guidelines. Now I'm saying this just as an issue because it's not this way. It's not interpreted the way that I'm telling you, but I think it should be, because child support is based on a pro rata income distribution. But nonetheless, it's not. So for now, the custodial parent would be entitled to it. So let's speak generally. As I started out saying, married joint filing joint is usually the most advantageous. Then it's head of household single, married filing separate. It doesn't say that it's one size fits all. So you do need to consider the other issues, not only the tax rates, but consequences about tax filing and possibly unreported income issues, which we'll touch on later. So this is really just where you want to start from. And of course, like I was saying, there's always an exception, and I touched on it a second ago. And there's underreporting or not reporting, non-filing taxpayers. There are a lot of personal issues aside from the dollars and cents of it that should be considered when electing which one you want to file. So moving into timing of the divorce, if you're contemplating a divorce near the end, you need to consider, and you should consider before you actually file, which is going to make it better for you at the time. These are just kind of basic guidelines you want to keep in mind. If you're filing before the end of the year, or if your divorce is effective before the end of the year, wait, I want to make sure that's right. Just considerations. Before you want to determine is it going to be better to file single or after the end of the year, to whether it's going to be a joint. So these considerations are only going to be important if you have some control over when your divorce gets entered. A practice in New Jersey, for instance, is you might get divorced on Wednesday, September 1st in court by the judge, but the paperwork might be actually filed and signed a month later. So you'll have appeared on one day and the divorce paperwork says another day, but you're actually divorced on the first one. However, I have had cases where we've gone to the judge, and it's not covertly, it's on the record and on the up and up, and we say, look, for tax reasons, we either need to have this done in December, or we're going to get divorced in December because my client wants to remarry, but the paperwork needs to say January for tax purposes. And sometimes you can actually coordinate that to where it's most advantageous. One little caveat, there's usually one person in a marriage that's less financially savvy than the other, or at least as far as it comes to tax considerations, given how complex they are. And you really need to understand all these things before you sign a joint tax return, especially if you're in the position of having marital problems. They are often financial, or at least they often include financial, and there's often trust issues that either are or will develop. So you need to understand all of these issues that we just discussed before you decide whether or not to sign a tax return with a party that you are or may be divorcing soon. So let's take a look at an option you have if you do file unknowingly a poor tax return, or one that doesn't disclose the proper amount of income. There are actually a couple of things that you have options to do. I'm only going to talk about one at length, and that's the innocent spouse relief. The IRS allows for certain qualifications for a married couple if one person is claiming to be, quote unquote, innocent spouse. So the first qualification, it needs to be a joint tax return. And one person has to have improperly reported income. And it could be you or your former spouse, because you might just discover this after your divorce is over and the issue comes up. when you signed a return, you did not know, but here's the the legal jargon you got to watch it, and had no reason to know the return was incorrect. Either you didn't know the income because your spouse controlled it, or you didn't see you didn't see the deposits, whatever it should be. One thing to keep in mind when it comes to the standard of had no reason to know, if you're signing a tax return that says you have $100,000 of gross income and you're living in a $6,500 mortgaged house, you have reason to know that there's more money than you're reporting. And last, I believe it's last, it would be unfair to hold you liable for the unpaid tax. Now, it's very narrowly construed because there's no way to know what is and is not unfair, and you're dealing with the IRS. They generally think everything is fair to them. But it's there just in case there is a problem, to know that if you happen to be the less sophisticated spouse, or you're subject to bad decisions by your spouse, and you're not necessarily, for lack of better words, married to your tax return. There are also abatement of penalties. There's equitable relief. I'm not going to get into those. I don't think they're necessarily relevant to specifically a matrimonial divorce action, but innocent spouse is. That's why it's here. Now let's move on to the topic that half of you love and half of you hate, and that is alimony. So let's talk about the tax consequences for alimony. Alimony is included in gross income for the person who's paying it. Is included in gross income of the person receiving it, and is a deduction from alimony for the person who is paying it. So the person who pays it, their taxes are reduced. So the net effect of that is you're sort of paying less in alimony because you save some of the tax. The person receiving alimony is actually receiving less than he or she believes, because there's going to be, or may be, an income tax to the receipt. And these are just the code provisions that reference why that is, if you're interested in reading further. In order to be considered alimony taxable, and this is important for everybody that has it, there are certain requirements that must be in the court order specifying it in order to take it as deductions. Because just because a judge says this is going to be alimony doesn't necessarily mean it's going to be by the IRS. They're not bound by what a judge says, so it needs to be written right. So the 5 requirements we're going to look at, it's got to be in cash. And that doesn't mean they got to give you cash, but it means it's got to be an actual payment, as opposed to like an offset or a credit or an adjustment to something else. It's got to be an actual payment made. It's got to be pursuant to a divorce or separation agreement that doesn't, and this is why the law is always so complicated, does not designate it as anything other than alimony. Meaning it doesn't say, it doesn't have to say it's alimony, but it can't say that it's something else, if that makes sense. Next, the payments do not continue after the death of the recipient. And this is important because in most orders that the courts enter, at least a temporary order for support, which we'll talk about soon, they do not have this language. I generally will put it in my orders, or I'll ask judges to include it in pedente lite applications, which is like the temporary short-term alimony, and they usually refuse to, which is problematic because pedente lite alimony can be deductible also, and we'll talk about that. But for this, these in your final agreements for alimony and in your temporary, but these 5, here we have 3, we'll get into the next 2 in a second, must be in there and in that kind of language, or at least language close enough to indicate the same meaning. The provisions, I wish this would stay on. And again, we have a sort of a negative here. The provisions of the instrument, what that means is the agreement or court order does not preclude the deduction by the payer spouse, meaning the person, the order or judgment does not say that the person paying can't take the deduction. Again, it'd be so much easier if they would just say the instrument says the deduction, but it doesn't really mean that. It doesn't have to say it, it just can't prohibit it. Hopefully that's clear. And again, spouses who are legally separated, once again, this is popping up under a divorce decree or a separate maintenance. And that's sometimes what a pedente lite order is called, because it's not a divorce decree, will qualify. So you need all 5 to be able to take it for tax deductions. Now let's talk about the pedente lite payments. This is a significant issue because temporary payment, I like to call them temporary alimony payments instead of penalty because it's just, it's an annoying phrase, but it is the common one used. It is an issue because courts will normally call penalty unallocated. And the purpose behind that is to say it's not child support, it's not alimony. We haven't decided what it is. Some judges will even go so far as to say they'll say that and then they'll say the opposite. You'll get an order that says it's unallocated alimony and child support, and we're allocating X dollars for child support. That's done because some of the probation departments in the courthouses, which are the ones who handle the collection and disbursement and enforcement of child support, sometimes need an order to say how much is child support so they know how much to actually collect. So the order is saying that it's not allocated, but this amount is child support. So it's a horrible mess that they're creating. But even bigger is the conflict that decision of itself draws. Because in my experience, courts believe or intend the unallocated distribution to mean it can't be deducted at all unless it's later allocated or agreed to be allocated. But the problem is, and the case is down here, the IRS case law says just the opposite. It says that if you have unallocated support, it's deemed alimony. So there's a conflict between what the court says about it, what the IRS says about it. I've never seen the issue forced into either the tax court or even forced into the appellate issues or appellate division, but I've dealt with the issue at the trial court level on a number of occasions. So a little more on penalty levy, unallocated penalty levy. The way to avoid it, the way I try to avoid it, is I either put in my order that it's going to be allocated, or if the court won't put in the order, I ask that they put on the record that we're reserving the right to allocate it at a later time. You want to make sure it's stated somewhere, whether it's in the physical paper that the court signs or on the record when you're making your argument. But it's got to be there, because if you lose that right, you may lose a significant right, because penalty alimony can not only be a significant sum of money, it can last for a significant period of time. Nothing that dictates how quick or long a divorce case will last. Here is the statute for alimony, and helps you address the tax consequences. Is one consideration inside of that statute that the court is supposed to consider when awarding alimony. And that goes, that could be a lot of things, but that goes, I think, primarily to what I said in the beginning, that sometimes the addition of alimony raises your tax level, your tax rate, and reduces or negates some of the benefit you hope to get. And here's a case I just put for reference, Malamo versus Malamo. The case basically stands for the proposition that penende lite alimony can be retroactively modified at the end of a divorce case if it was found to be incorrect when set by the trial court judge. The reason is when penende lite alimony is determined, it's usually determined very quickly without sufficient information. So the courts reserve the right to go back. Now, the problem with this case is that it handcuffs you to that temporary order, because if you go to modify it when you do have all the information, judges say we're not going to modify it because you can modify it at the end. But at the end is not when you need it modified. If you're the one paying it and you can't afford it, you need it modified immediately. If you're the one receiving it and it's not high enough, you need it immediately. Getting a break at the end when you've suffered for 10, 12, 24 months and paying or not receiving the money, the promise of retroactivity is meaningless. But more importantly, I've never seen it ever be done. In 20-something years of practice, I've never seen a retroactive modification of penende lite alimony by court order or by agreement. So never, in my opinion, if that's something they're telling you not to worry about, you can count on Malamo, don't. Child support and child care expenses. I'm going to move kind of quickly through the latter parts of this. I'll give you the basics, but then I'm going to move past a lot of like the complicated portions, because I want to keep us as well on track as I can, and a lot of this gets messy that you're not likely to take much from anyway. But so first of all, child support in essence is not included in the gross income of the parent receiving it, not deducted by the parent paying it. So it is the complete opposite of alimony. And it's based on the fact that you have an obligation to support your child, so that you shouldn't be receiving any kind of benefits or change in your income for it. You don't want the parent who's a custodial parent to have a tax burden because they're getting money to support their child. Here is just a case for those that are interested in research that indicates that discretion in allocating tax exemptions, it's up to the court to decide. They can either alternate, they can give to one parent, they can divide it. It's a big issue because it's sometimes a very significant tax benefit to people, and it's one that often lasts many, many years. And if you have several children, it can add to a significant sum of money. So there is a significant conflict in a lot of cases. So you might want to jot down this case if you are or going to be in one of those types of cases. The dependency exemption, here's just how it breaks down. My pen. The deductions allowed for a person who qualifies as the taxpayer's dependent, and it allows the exemption for each dependent, unless otherwise provided the exemption is $2,000. Now there is more to it. Tax code is never that simple. There is a phase out. If your gross income exceeds, this again, where they make it impossible. If your gross income exceeds the threshold amount, now you notice in here it doesn't say what the threshold amount, we'll get that. The exemption can be reduced by an applicable percentage. So you have to go somewhere else for the applicable percentage, which is 2% for $2,500 over the threshold. So what is the threshold? Threshold is right here. $150,000 filing joint or surviving spouse, $125 head of household, $100 for individual, and $75 for married. Give you a second if you want to just jot those down, and I could spend a great deal of time discussing them. I think it's, I was going to say pretty clear. I guess it's clear as the code gets. Now, when you are discussing exemptions and the ability to transfer exemptions, there is a Form 8332 that needs to be signed. This basically allows parents to trade the exemptions back and forth. If you're the custodial parent and you're entitled to the exemption, you can give the other parent the exemption, but you must complete the 8332 for them. Because the exemption, as mentioned here, also brings the child credit along with it. And there's going to be some we're going to talk about briefly here. The lifetime learning credit, the American Opportunity Credit are not tied to this, but getting the exemption carries the right to use the child credit, which also brings these along with it. So if you give up one, you may be giving up all of them. And that's why it's something you need to consider. And you need to understand all of these. So I'm going to just give you some of the information here. This was previously called the Hope College Credit, now called the American Opportunity Credit. It's worth up to $2,500 for the first 4 years of college. It's just basically for a tax deduction for the payment of educational expenses. So just make a note of that. Again, I'm going to move a little quickly through these so that we get to it. It's also like the other one. There are phase out levels between 80 and 90,000 on single returns, and between 160 and 180 on joint returns, which simply means if your incomes are at these levels, your adjusted gross incomes at least, that you start to lose the potential deduction on some of these. Next, the lifetime learning credit. Again, it's if you've incurred educational expenses. It's ability to get some tax breaks to encourage the fostering of education. You have to be at least a part-time student, and it can be claimed for educational expenses incurred. You'll need to talk to an accountant to make sure what that is. I do not believe it would count like commuting costs and car insurance if you're a commuter, but it more likely would be, housing, tuition, fees, books, things like that. Now it's for the taxpayer spouse, or the dependent. So any one of you that are going may still be entitled to this credit. Now there's a little more to give you on this credit here. It's 20% for the first $10,000 of tuition and expenses. and the maximum credit is $2,000 per household. Let's give you a second if you're jotting that down before we move on. Lastly, the just in case you're writing this down, it's available on a per taxpayer family basis. Gets phased out at the levels we were talking about a moment ago. Real quick, we'll just shoot back so that you can see the levels. Those are the levels, so they phase out the same levels. Make a quick note so we can move on. Oh, moving the wrong way. So when you have multiple children, a lot of times parents will share or split the exemptions. If, say, you have 2 children, each of you take 1. If you have 3, you do 2, and the other one does 1, and then you alternate. Not always the best idea. It's the simplest, especially when you're in, maybe a very contentious divorce. But I generally advise people to stop and take a look at the advantages and disadvantages. If there's a significant discrepancy in your incomes and your income levels, then the tax effect of having or giving up exemptions will be significantly different for each of the parties. My approach, my recommendation, and what I try to do in my cases is try to take both parents at least and get them to start talking about a common agreement. Find out from a tax professional who's going to maximize the deduction. Then we find out what the other person would be. So let's say, for instance, dad would save $3,000 by taking all the children, and mom would save $1,000 by taking all the children, or however this breaks down, just for number purposes. Well, what would make most sense is let dad take them and pay mom $1,000 because he's still coming out $2,000 ahead and she's breaking even. You could even do $1,500 each so that you're breaking even but maximizing the deduction. The point is, don't get wrapped up in fighting over who gets what. Look at what's actually going to be the net effect of these decisions and then decide what's going to be best for everybody. Another issue that comes up, childcare credit. Parents with custody or children are entitled to a credit of 20 to 35% work-related childcare. Important thing to get here is work-related childcare. A lot of childcare issues. First of all, often childcare is not necessarily work-related. Sometimes people use it for socialization. Sometimes they use it because they want some time alone. Sometimes it's considered like camp, which we'll talk about in a second, in the summertime or holiday vacations when there's extended absences from school. Aren't always necessarily work-related, so you want to make sure that the child or the child care facility or child care expense that you're going to choose is going to fit into your deductibility, because child care, as I'm sure your parents know, very expensive. So you want to be able to maximize. It cannot be traded, so it's got to be the custodial parent, and you not necessarily the one paying it, but the custodial parent's entitled to the deduction. Again, this is one area where you may want to try to maximize cooperation so that even if one parent is paying it, one parent gets the deduction, let the other person share, or vice versa. You may also factor it into support payments. You may give away a tax benefit so that you may pay less somewhere else. Additional areas, like I was saying, day camps sometimes can be. There's certain deductibles. Some businesses also offer dependent care reimbursement accounts and dependent care credit issues. Overnight camps do not qualify. I don't know why that is, to be honest with you. Again, I have to go to a tax professional. I would think to some extent the day part of it should be, even if the night part isn't. They should look to break down and maybe deduct a portion of it. But as I know, as it stands now, that is the current law. Let's move into equitable distribution. That is the distribution of assets and debts in your divorce case. It usually is done at the end of your divorce, or at least it's one of the issues that finalizes a divorce. Generally, there is no income or gift tax consequence to assets transferred between spouses or former spouses. It says, but incident to a divorce, meaning if you're divorced and you're transferring assets, but it's because your divorce order says that you need to do it, or your divorce agreement says. So if you get divorced and you have to transfer your house afterwards, that counts. But if you get divorced and a couple years later you transfer assets because it's more advantageous or you make an agreement, that will not qualify. Only if it's incident to a divorce, which we'll show you here the definition. In order to be incident to a divorce, it must be within 1 year after the date that the marriage ceases, which would usually be by a court-ordered divorce, or is related to the end of the marriage. Now, how it's related to the end of the marriage, if it's pursuant to a divorce or separation instrument. Instrument can be a court order or judgment. It can be an agreement. And it doesn't occur more than 6 years after the date. And the reason I think is just because of capital gain issues that we'll talk about, and just the changing income tax rates that occur. If you have property, and also just to make sure it's more efficient use of the tax and of the property, in order to be incident to a divorce, it's simply got to be part of a divorce agreement or order, and it has to be within 6 years. When you do that, even though there's no tax incurred, there are tax considerations. First is going to be the basis. Basis means the value of the property that you're receiving, which becomes important when you later sell it. So when you transfer property, it's transferred and it's considered as a gift. And that's important because when you receive a gift, you receive what's called the transfer basis, which means the value of the property. And when I say property, I don't mean house or real, I mean any property. It could be jewelry, it could be investment accounts. It's the transfer basis, which means the value the person bought it at. So if you bought a house for $300,000, $300,000 is the basis. If you transferred your house that you bought for $300,000 to your spouse, the basis is $300,000. Simple enough, you would think. Does not apply to non-resident aliens. That's the exception. I don't know why, but it's important to know. And it's actually very important to make a note because citizenship and residency is not necessarily very significant in divorce actions, and I have the issue asked and raised often. But it is very significant when it comes to equitable distribution and estate planning. So you need to keep in mind, especially those family practitioners or estate practitioners that maybe dabble a little bit into all of these areas. Now, the exception has an exception. Does not apply to property in trust, and an exception to that, the sum of the liabilities assumed plus the amount of the liabilities to which the property is subject exceeds the total adjusted basis of the property transferred. Not going to go into that. I think it's going to make your ears bleed, and it's just unnecessary. But I did want to point out, just so that if you are transferring property and you are or dealing with a non-resident alien, you do want to be aware that these issues exist. Next important aspect of equitable distribution will be retirement accounts. They generally do not fall under this because they're going to be divided differently. They are divided by an instrument called a qualified domestic relations order, QDRO, QDRO. The QDRO is a court order that allows a retirement account of one person to be divided and part of it paid out at some point to another. The reason is the federal law that creates the retirement account, the tax deferred protections only apply to an employee, and the other spouse is generally not an employee but receiving it. So they came up with a mechanism that a court order can allow the retirement account to be divided into two accounts, and the second account paid over to the non-employee spouse, which is called the alternate payee, under this order, and still receive the protected tax aspects of the retirement account that the employee gets. Next, a very common asset to be transferred, marital home. Gross income will not include the gain if, and there's always going to be 8 different things, if the property is during a 5-year period ending on a date of sale or exchange, that the property has been owned and used by the taxpayer as the principal residence for a period of 2 years or more. What that means, I'm going to try to kind of illustrate it because it's, again, the IRS code makes things dreadful. In a 5-year period of time, 1, 2, 3, 4, 5. This is where the house is being sold. 5-year period ending on the date of the sale. The property has been owned and used as a principal residence for a period aggregating 2 years or more. So if you used it in here for 3 years, it qualifies. If you used it here for 2 years, it qualifies. If you use it back here, the first 2 years, it qualifies. It's the 2 years within the 5 that this provision is talking about. So if you have 2 years inside of the last 5, it's not included. It's exempt, but not all of it. The exemption shall not exceed $250 for an individual and $500 for a married couple. In this current market, most of us aren't fortunate enough to have that much equity anyway. Turn real quick to a question that people will often ask. I threw this in just because it's a question I have all the time. It's on another webinar I did about divorce misconceptions. If I move out, will I still own an interest? People often talk about abandonment. As far as equitable distribution, if you move out of the house and the spouse has the right to live, either because of your own agreement or a separation agreement, for the purposes I just talked about, the residence will still be considered your residence, even if you didn't live in there inside of that 2-year period of time. The other spouse's 2-year use will count as yours so long as you left it pursuant to a divorce or separation agreement, and only for tax purposes. As far as divorce litigations, you never lose your interest in it. We're only talking about whether or not the profit on the sale is counted in your gross income or not. Now, just a point to know here, when you do receive it, though you're not receiving a tax incurring it, you will be responsible for the tax for the increase in the value. And that's a capital gain tax. It's called a capital gain tax. Generally, that's what it's going to be. And as of now, it's about 20% on the capital gain. So here I gave a small example. You purchase a stock while you're married for $100 and it sells for $200. You're going to pay $20 in income tax. That's going to be the same as if your spouse had a stock account that they bought for $100, but it was worth $2 at the divorce, and you take it thinking you're getting $200. If you sold it, you would have $180. And I give you another example of that here. Same concept, different numbers, a little more common, because what will often happen, people will trade one asset, a large asset, for another asset. One spouse will want to keep the house, and one would want to take his or her retirement account. So they'll say, okay, the numbers are the same. House is worth $400, retirement's worth $400. We'll keep each. That's not necessarily the same. In this example here, the house was purchased for $100,000 when they got married. It's now worth $400. So you have a $300,000 gain. When that's sold, you're going to have capital gain. So even though it's worth $400, you're only going to come out with $360. Now, if you gave up a retirement account or any asset of equal value for this house, you're actually coming in $40,000 under. One more thing, I don't think there's a slide in here for it because it gets to be a little complicated, but you need also the tax consequence to a retirement account can also be significant, sometimes even much more significant. Most tax accounts, or not tax accounts, retirement accounts are tax deferred or tax protected, which means that as the assets grow and as you contribute, there aren't many, if any, tax consequences. And if you take it out at retirement or at certain points that they're permitted to be withdrawn, there's no tax consequence. But if you're taking the money out anytime before that, there's going to be significant tax and penalties, sometimes upwards of 40 to 50%. So in my IRA house analysis, if somebody took the house for $400 and they sell, they get $360, they might think that's shitty. But if you had a $400,000 IRA account and you closed it out prematurely, you may end up with $200,000. So that's a significant decrease. So the ability to liquidate an asset minus the tax consequence is also very significant to consider when dividing up assets in a divorce. Let's move on to another topic that's usually very important to people, very complicated. Deduction of legal fees. Now, generally speaking, legal fees are not deductible. So even though I say here it's useful negotiation, the general rule is they're not deductible. There are, of course, like everything else, exceptions. The exceptions, let me move back to the next slide. All right, so again, always talk to a tax professional before taking everything that I'm saying as gospel. But there are certain exceptions. Generally speaking, well, let me show you the code to find out if you want to read about this to try to determine if your expenses will be. Here's the IRS code. Ordinary and necessary expenses incurred in the production or collection of income. And the brackets are including attorney's fees and collection of income, alimony, for instance. So this is the code provision that speaks to all deductions, not just attorney's fees. So the reason why it's complex is it first has to fall into the ordinary necessary expenses. Now, there's a couple I'm going to walk through quickly, but the overall concept to understanding the deductibility of attorney's fees in a divorce is if the fees were incurred for either the production of an income or the protection of an asset. Alimony, equitable distribution, capital gains, tax planning, these issues will all be deductible, or can be deductible, I should say. I'll give you some slides in a second that break it down, but the important thing to really take from this before you look at all these different exceptions and the IRS provisions for it and make it really confusing is the key, aside from it being for the production or collection of income or the protection of an asset, is you need to be able to establish that. So I generally put into my bills, for instance, a good deal of description of the item so that you can later go back and determine which one was discussions about alimony, which ones were about capital gains and tax planning, because it's there. You need to make sure that your attorney is itemizing for you during or does so for you afterwards which fees were incurred for items that would be either protection of assets or production of income so that you can take the deductions. Here are the provisions for alimony, only for the paying spouse, the one receiving it. The alimony's got to fit the definitions that I talked about under the IRC 71. It's got to be applicable to divorce matters. That can be post-judgment, enforcement, collection of arrears. That still applies even though it's after your judgment. Does not apply to the person paying. Another example, qualified retirement plans. They may be tax deductible again. The quadra that we talked about, the fees for the appraisals of the valuations, the distribution of it, all may be taxable. Here, I think I want to make a change in the slide. Made a note. Oh. It says portions of the attorney's fees incurred by the alternate paying in this regard would be, maybe, considered deductible. There's never a certainty. There's no black and white when it comes to the IRS code. Now, one additional aspect when it comes to qualified retirement plans, again, which is troublesome if you're not comfortable reading legal code. They're itemized deductions, like a mortgage deduction, for instance. They fall into the same deduction. They are deductible to the extent they exceed 2% of your adjusted gross income, which means your adjusted gross income is your income minus your itemized deductions, like your mortgage interest. If your fees were 2% greater than what that number is, that amount is deductible. But there's also phase out limits to that, so I'm not going to go into. Just know that it's there, so when you talk to your accountant about whether or not it's deductible. And then now the second aspect I was telling you about, when it's protecting an asset fees to protect assets may be taxed, or the fees may be deductible. There's also there may be some ability to add it to the basis of the property. So if you spend $10,000 in legal fees preserving a property, the property, let's say the example I gave you before of $400,000 with a basis of $100,000 may actually be a basis of $110,000 because of the legal fees. So the tax consequence in that example would be reduced by the legal fees that were added to its basis. Here's a case that gives you that an example of it. If you want to jot this down, it's not a New Jersey case. It's a federal supplement case, which is the federal district. But this was a person who was defending title to a stock, and the fees for the defense were, I believe, added to the basis. One last option you have is to consider the payment of fees as additional alimony. If you're paying the other spouse's fees, for instance, whether by agreement or an order, you may be able to seek to take it. You may be able to do it by agreement as additional alimony. It's complicated, not only because it's complicated because it's tax, but in few cases, rare cases, I would think, would the person receiving the payment benefit from having it be alimony, because as we said in the very beginning, alimony is taxable. So somebody's paying your legal fees for you, but you have a tax bill, you still have an expense. So you're not getting the full amount. You must know at least that these are those triggers. These are the issues you need to be looking at. Like somebody's paying your legal fees but taking his alimony, what's your tax going to be? And is it going to change your tax rate, which increases the tax to beyond what you might be even contemplating? If it is going to be additional alimony, it needs to be worded that way. I know I sound like a broken record, but I've been saying it the whole time. If you're going to be doing these things, you need to speak with both, definitely an accountant, but you should also speak with a lawyer. One of the few times I'd probably say speak to the accountant before speaking to the lawyer, but nonetheless, you want to try to make it both. I'm going to launch into no, you know what? I may not do the polls. Normally, I would do some polls here to see a little client intake, but we're running on the hour, and I do see there are some questions. So I think I'm going to jump right into the questions and see what we can do for you. Give me 1 second to open up. All right, so let's see. One question is, I'm going to read the question out loud as I read through it. So if my language doesn't sound right, it's because the question is just written that way. How hard is it to claim the child or children on your taxes for non-custodial parent if it was not listed in your divorce settlement? If it's not listed in a divorce settlement or any kind of settlement or any kind of agreement, and you're not the custodial parent, it's difficult because the IRS guidelines presume two things. They presume that the person providing, and I went through this earlier, the person providing 50% or more of the child's support or housing cost is entitled to the child deduction. It also presumes that it's the custodial parent who is providing that 50%. And that's the reason why earlier I said I disagree with it, because the New Jersey child support guidelines allocate the percentage of child support being paid under its guidelines, so the higher earning spouse is paying more than 50%, whether or not it's custodial or non-custodial. But family court judges and the IRS all disagree with me. So as of now, the answer is it's very difficult because the IRS guidelines presume the custodial parent gets that. Any other questions? It's the only one that I see that was posted. And sometimes the tax things are so complicated you don't even know what to ask. There is a link on my website, www.micklinlawgroup.com. Not the Micklin Law Group, just micklinlawgroup.com. The financial aspects of a divorce. Actually, let me see if I can pull that up real quick, since you're all looking at my screen. Our website actually has several ebooks in first, right up here. Financial impact of divorce. We'll cover the issues that I discussed here and a lot of other issues at a much greater length. That's going to be taken down soon for those of you that may be irritated by those kind of pop-ups. I am too, so we're taking them off. But this ebook here You click on it now. It will ask you, currently it asks you for your email, and that remains confidential in here. It will be soon available without having to give your email. You can just simply download it, as will all the other information. But that change is not in effect yet. I'm putting that in effect soon. But if you're still looking at some of the information here and some of it's unclear, I'd recommend the financial impact document. Also, here's a family law handbook, which gives you a lot of terms, not necessarily tax terms, but family law terms. It's a good supplement to the first one. Those will help you. All right, let me take one more check to see if I have any questions that I missed. Okay, I don't see any. I don't think, I'm not going to take your time to run the poll. I'm going to let you go and enjoy your evening. Do appreciate you coming out, or at least being online for this webinar. We generally do them the last Thursday of every month. I do not know, but I can quickly find out for you. Our next webinar, in case you want to register for that. Let me see. And this is where the webinars are going to be listed, actually. If there's a webinar page, you see the webinar archive. Pull down to go see this one in the future, as well as the past ones we've done. Upcoming webinars, the next one we have is Avoiding Common Estate Planning Mistakes, February 23rd, 6:30. Estate planning is important for everybody, divorcing or not. Probably more important, not more important, but it's certainly an issue you want to consider if you are divorcing. Sometimes people get so wrapped up they forget the importance of it. So we'll be doing that, and here are the other ones that follow the months after. They are possibly subject to change. I'm making some changes in the work that we're doing for people, so these may or may not be changed in our future. But for right now, this is what we have. If you have any questions about them, you can always give me a call. Here's our phone number. You can also send me an email. I think you all have my email from this registration. So with that, I'm going to thank you for coming and wish you a good night.